Now you guys can see?
I can see it now.
Okay, cool. I'm ready.
All right. I want to give a warm intro. This is my partner, Chris, on the projects we've been working on in Florida. I figured this would be a good opportunity to kind of peel back some of the layers and see what people are actually doing as your general partners on syndications. That being said, I'm going to let Chris take over from here. He's got several hundred units under management, the most recent of which was this 92 unit that we purchased in Florida. We're currently on the way to becoming vertically integrated. Right, we're about to merge in our property management company and take it over to the next level. And without further ado, I'm going to let Chris take it over from here on the 102.
Great, thanks, you guys. So continue from the previous 101. Hopefully, you guys had time to kind of look into some of the things that was discussed with Nelson. But we'll touch base a little bit, just give us everybody a quick recap of what some of the things we talked about. But let's make this thing more interactive. So anytime you want to ask a question, you can use the chat functionality. So Nelson, if you can help me narrate any questions, and then if you want to raise your hands or just start the conversation and the presentation and just ask question, that's fine too. Okay, so going into some of the things, we're going to do a quick recap of 101 that we talked about, and then we're going to dive into the deal, why we're picking deal in certain locations, how does the underwriting works, and what does it feel like to actually have your projection done on paper, and then 6 months later to see it in real life, whether you're right, wrong, or too conservative. All right. So a quick recap. Syndication 101. So one thing you need to know about commercial real estate for apartment complex, everything lives around this formula. Your market value of your property is the net operating income divided by the cap rate. Okay. To overly simplify, net operating income is basically your revenue minus your expenses, which includes your insurance and your property taxes. Mortgage payment and interest are not part of the NOI calculation in commercial real estate, okay? Cap rate is something that you can find from CBRE article. We'll have a link to the Florida ones later, but it's a nationally published out every quarterly that tells you Class A, Class B, Class C, what is the market cap rate for that, okay? So that's one formula you really want to know in terms of syndication, how the commercial real estate works. Some of the things that we talked about, and I'll go over this very quickly, but if you have more questions, want to watch the video later, we'll have a link after this webinar so you can go back to refresh on 101. But basically a simple calculation, you should normally see these type of syndication operating memorandum or offering you see on the web. Typically on a 8% return, let's say, right? Say they're going to offer you a typical tagline you see up here, typical deal. Let me show you this way. Does it work? Okay. Cool. Normally you see an email blast from a syndicator. They're going to offer something like an 8% or 10% annual return, and it's going to double your money in 3 to 5 years. Okay. So that sounds real attractive. What does that really mean? If you invest $100,000, 8% pref, that means every year you get $8,000 in profit share, okay? When you decide to sell, well, where's the 2x? So imagine you keep putting in 100, you get 200 back, right? So over the course of 3 years, you're getting 8% pref, which is 8,000 a year. What's left over is that 76, and then you get your original back, your original 100 back. So 100 plus 76 plus this is 200K, okay? So that's how they do it. And that's why a lot of syndicators, quote unquote, they have to sell, because to give you that 2x, double your money scenario, it's going to take a very long time if we're only giving out 8% per year, right? Mathematically, that's how it works, okay? So that's 101 in a nutshell. So what does syndicator like myself and Nelson do? We find things to buy, okay? My style, which could be different than other syndicators, I particularly look for jobs, money, and construction in that particular location. Okay, jobs, money, and construction. Why? Because at the end of the day, we're trying to boost the NOI, which is revenue. And in order for me to do that, I need to push rent, right? I need to charge extra stuff like that. So basically taking something from the original price and push it up. So I need higher jobs, I need more money, and I need more construction, because all those are signs of marketing. The entire sub-market is moving up, right? That's how I know there's going to be people in that city that can afford the higher value I'm offering. Otherwise, why do it? Okay. So this is one reason why we like Florida so much. Okay. If you're seeing all the announcements and so forth, this is just Jacksonville. Okay. Jacksonville has been trending at 3.2 unemployment rate, where the national is 3.6. So there's a lot of jobs going into the Jacksonville market. If you compare where people are increasing rent from, again, speaking in terms of money, right? Out of this chart, you can see as of February of this year, number one is Florida and Miami. So 1, 2, 3, 4. 4 out of 10 is in Florida. 2 out of 10 is in Texas. So I'm surprised that this doesn't have Dallas, but Austin for obvious reasons, and then San Antonio. And then you have a mixed match. Not a surprise that Phoenix is on there. Everybody heard great news about it. So there's an easier opportunity to increase rent because the overall market has been performing just stellar, right? And then we look at construction news. Who's building what? We as syndicators or passive investors, we're small potato compared, Elon Musk or whoever, right? So if they're making big moves into building large complexes or hospitals or any type of major expansion, then that's where you kind of want to follow, because if they're spending multi-million, they're spending billions of dollars investing into a city, they're going to be there for a long term. Don't confuse that with retail news. New Chick-fil-A open in, La La Land, Florida, new McDonald's or whatever. Those guys can kind of get in and out of the market quicker, because build a new Chick-fil-A is probably $1 million to $2 million. Where you're building a brand new headquarters or large complex, those are in the billions. So there's a lot more planning, and they're there to stay longer term. Okay. So those are the things that we kind of look for. Go ahead.
I would also say, be careful when people say tech companies are moving into the city, especially if it's only an Amazon facility or a data center. Right. Those typically aren't necessarily the highest paying jobs. For example, at the Amazon distribution centers, on average, a lot of those the day-to-day laborers make about $17 an hour on average. So it might be beneficial if you're in a C or D class neighborhood, but if you're in like a class A neighborhood in the Midwest and an Amazon facility moves in, it's not going to benefit the city much in that area in particular. And same thing with data centers. A data center will be $1 billion project, but you'll hire 12 people for it, long term. It doesn't actually bring that many jobs to the town. Even I think a distribution center is typically better, because at least you'll employ more people compared to the data center. So make sure you figure out what tech jobs are actually coming in, and that's not just a company that's for example, Toyota, right? They come in, they build a factory. Are they taking that money and reinvesting in the city, or are they just sending the money back to Japan and then not spending it in the US, right? So
yeah, and that's a great article. Maybe we send it out to the group later. So there's a lot of internet excitement about Facebook is picking Temple, Texas, which is north of Austin, to build I think, $100 million data center, but they're only hiring like 200 people. So not too exciting compared to, I think it was Google already leased out the downtown office. It's going to have Yeah, I need to double check a number, but I think Google announced that they will have 3,000 people occupying that office in downtown. So we know Google doesn't produce anything, it's all IT folks, right? And then data center, just people making sure the lights on and computer runs. So those are exactly to Nelson's point. Yes, you want to get excited about big names making big dollars, but you want to see who stays, right? Who's actually going to pay rent. That's all. All right. Any questions so far? Quick thumbs up, everybody good?
Someone asked, what are your thoughts on Columbus and Intel? Columbus recently got an injection of money, I believe, from Intel. What are your thoughts on that?
So I like to follow the trend. Okay. One guy going in, there's a lot of companies going to different locations. Okay. But if it's just one company, their impact to that city is not as large. But like I love to kind of use Elon Musk, right? Because everybody understand what he's doing. He's not only coming in, bringing all his companies to the headquarters, but he's bringing his friends to Austin, right? So that itself, Austin, no matter how expensive it is, it's going to keep rising. And that's the trend we see. Columbus, Ohio, Intel is going to be there, but who's the next guy, right? So that's kind of competitive, continuous news that I'm looking for.
I will say the new Intel site, it is like a chip manufacturing facility. So they are going to have a lot of white collar jobs that pay pretty well out there. So it does bode well. I would just say Intel is not exactly leading the pack at the moment. If it was NVIDIA or AMD, I'd be more excited about it. But Intel is kind of struggling at the moment. They are really leaning in, for example, into their data center business, which even now they're losing market share to because they've already lost a lot of the consumer market at the moment. So
that's actually a good tip too. So if you like manufacturing jobs, one trend I start to look for now is supply chain. There is a lot more announcement now that US are manufacturing more here in America than is overseas. So all these news that you hear about, hey, supply chain, we cannot even buy a dishwasher until 6 months later. Those are indicative of what's going on. And, factory in China still sometimes shuts down. So if you guys know, China produced 85% of global materials. That's where the supply chain issue is coming from. So United States is trying to fix that. So follow those construction news, supply chain news, where people are producing. Okay. Any other good questions? All right. So we talked about Jacksonville. All right. So this is just kind of my style. Eventually, I will take my money and give it to another sponsor and let them make more money for me. Okay. So what do I look for in other GPs? Okay. Typically, number one is you got to make sure the rental increase is validated by a comparable local submarket comps. Be careful what they kind of showcase you, okay? It's sometimes cool that you're taking a C class property, put in all the shiny stainless steel, granite countertops, and you want to call yourself a B plus, but make sure that what they're comparing themselves to in the B or B plus neighborhood, it's within that proximity, right? My rule of thumb is 3 miles. Don't go past 3 miles, okay? If you start getting too far, you're like, well, why would the rich guy come out to a poor neighborhood and vice versa, okay? Another thing I look for, expense ratio, roughly 50 to 55%, okay? That number is not a hard number. It's based upon market and based upon your management company. So I'll talk about it later. But if you don't know that neighborhood, that sub-market, 50 to 55% expense ratio, it's a good starting point. And then as part of the expense, making sure the syndicator have already adjusted, have already built in the increase in property tax, the payroll, and the insurance. Okay, don't fool yourself. Property tax is probably the most expensive thing right now in all the expense items. If you take something that was $5 million, now you pay $10 million for it, don't expect the property tax to stay at $5 million. It's definitely going to go up. So if the syndicator didn't adjust for that in their calculation, they're not doing themselves a favor. Okay. Reversion cap rate, sometimes you'll see that. That's easy to catch. Okay. We talked about the typical pitch is 8 to 10% cash on cash, double your money in 3 to 5 years, right? Everybody can do a quick math. If they're projecting that, hey, I'm only going to give you 2% cash on cash year over year, they're counting on that big appreciation at the bottom. Okay, that's when you look at the cap rate. Don't fall into the trap where they bought something for 3 cap. So now they're saying, oh, I'm conservative. I'm going to sell it for 4 cap when the market is expecting to be 5 cap. And with the change in the market now, maybe even 5.25. So if they're expecting to make money at 4 cap, realistically in 3 years, they can only sell at 5. Now you're going to lose a lot of money. Okay. So, practice what I preach. So this is what we kind of looked at back in November when we bought this property. Okay. The seller is currently
Hey, Chris,
renting it.
one sec. Could someone asked, Will's relatively familiar with startup syndicates, but relatively new to real estate syndicates. When it comes to real estate syndicates, what does carried interest look like? I believe carried interest, the terminology is associated with an asset management fee. But I think Chris can go over it in a bit, but typically asset management fees are between 1 to 2% of revenues generated in rent. Yeah, Chris, go ahead.
Yeah, you're spot on. Keep going.
Yeah, typically there's also a promote in syndications. So whoever's the general partner or operating it, they will usually try to get a 20 or 30% cut. Or for some other very experienced professionals, I know one particularly in Austin who's like a very large developer. He usually takes a 40% cut on his projects. So the promote changes depending on the level of how much capital wants to be placed within said city or operator. But it also changes just based on, it depends on the deal as well. But typically it'll be somewhere around 30%. So
yeah.
For the promote.
Okay. All right. So when we underwrote this deal, right? Again, this is paper analysis back in November. We're buying this property. We have great management company involved. This is what their feedbacks are. So the seller currently rents at, call it $950 for 2 bedrooms, and then $1,150 for 3 bedrooms. Our projection at the time, based on the feedback from the management company, we should be able to achieve $1,100 on 2 bedrooms and $1,300. Okay. These are kind of things that I particularly love. For this particular seller, they already did all the improvements on the inside, but they let the outside kind of bare and ugly. So you have all the brand new cabinetries, not a harsh surface countertops, but they have vinyl flooring throughout. What else? New doors, nice color paint. Everything looks good, but they're not pushing rent as high. Okay. So our opportunity is to buy it. Now, one thing you notice, originally the asking price was 11. We actually pay more than that, okay? Because we believe in the business plan and we understand how savvy our property management company is. So we feel comfortable going more and still achieve a relatively good return, okay? That 8 to 10% that we talked about. So we went ahead and do more than what's asking, not because we want to, because competition drove up the price, okay? And then with luck, with the right team, it turned out after we closed, this thing was appraised as is at close to 12 million. So we already made 400,000 just buying it, okay? Paper, quote unquote, paper value, okay? So what does that look like 6 months down the line? Okay, so sorry, paper analysis and more. Kind of we talked about, right? You want to make sure your reversion cap rate is correct. Your rent is validated, and then you adjust for property tax. So we know that we're going to bring rent quite a lot. Okay, so we expect a lot of people just say, no, thank you. I'll go find a cheaper place somewhere. So that's where the 25% economic vacancy comes from. Don't confuse this with physical vacancy, okay? Physical vacancy is you have an empty unit. Economic vacancy could be anything from delinquency, people just don't pay rent, skip out, right? Uh, rent discount that you have to give to a tenant. So let's say we're advertising for 1,300. They're like, not so much. Okay, well, how about if I give you 1,250? That $50 difference is the part of the economic vacancy calculation. When a tenant move out, you have to rehab and then put a new tenant in. That time difference where you don't get any rental income, that's also factored in into this 25% economic vacancy. Okay. And then, so why is there a 19% increase in expenses? We knew at the time of November when we purchased it, property tax for 2022 is already announced, set in stone. But in 2023, our property tax will increase based upon the purchase price. That's why the 19% is there. We knew the property tax is going to jump up in the second year. So now if you look at our expense ratio is 45% roughly all the way across. We have a very good property management company. Our business partner have used the same property management company on the previous 3 properties. So they have validated that, my business partner have validated that this is how cheap they can run and still make a lot of money in Jacksonville. And that's why we are able to adjust below 50% of my general guidelines that I mentioned earlier. Okay. So what does the reality look like today, 6 months after we kind of quote unquote guess how much money we can make?
Chris, this is too many numbers. You gotta make this easier for us to read, man.
All right. So just real high level, okay? We're achieving rental income higher than what we projected. 11% higher across the board, okay? Our expense ratio stays where we're targeted at, 45% across the board. And our overall NOI, net income, the formula we talked about, it's already above what we are hoping to achieve in year 1. Okay, so we're just kicking ass left and right. Okay.
Our April 2022 and May numbers are technically wrong on the expenses. We're still waiting for some numbers to come in, by the way, to clarify. It's probably going to be closer to 45% once we add in all the actual expenses. So.
That is correct. Yeah, we pulled these numbers first week of May. So obviously all your expenses have not completely done. That's why the ratio is very low right now. Good point, Nelson. All right. So another good thing to celebrate, right? We focus so much on pushing rent. So renewal is easy picking. Renewal means that the person are not moving out, but they are okay with paying you a higher rent. So here's the beauty of it. The same tenant is willing to stay and pay $200 more in rent without us even spending a single penny on upgrading that particular unit. One of the very expensive items is when tenants move out. They always leave some kind of damage. It takes about 30 to 60 days to rehab, clean up, and get it for rental. So if they don't leave and you can get that free bump, that's a lot of free money there. Okay. And one of the things that we never planned for, but it's kicking ass, new leases on our brand new upgraded units are achieving 1,200 on the 2 bedrooms and 1,350. So if you remember, we're projecting 11 and 13. So we're already achieving those. And then the next level upgrade, because we're doing so well, we actually implemented a higher upgrade. We're putting in washer and dryer connections, granite countertops, and stainless steel into the property. And those are we're getting 1,500 for 2 bedrooms and 1,600 for 3 bedrooms. So we're just kicking butts all over the place.
Basically, we're turning a C-class building and creating some B-class units, and we realize there are B-class tenants who want to live in this building.
Yes.
So another way to word it is just we're getting a better quality tenant than we thought we would, just because of how much the market's moved, but also just we're trying to test how high we can go with it still.
Yeah. And, I don't want to give credit. The property management company is the single most important thing in the whole operation. Okay. So they achieve tremendous amount, but also the market is helping too, right? Because we saw in the previous slides, Jacksonville on average is doing 24%. So not just us increasing rent, everybody else in Jacksonville is increasing rent. So compare what we're offering in the rent, a lot of tenants just say, hey, well, I might as well just stay here because it's a great place to live and we enjoyed all the wonderful amenity you're giving us. Okay.
Michael, you asked, how did you achieve the higher rents than projected? Did you advertise higher than projection to see if there were any bites? Yeah, that's what we did. We had one unit that was filled with mold and kind of rotted in a lot of places. So we figured,
Mildew?
let's take this to the nines and make this as mildew. Sorry to clarify, not mold, mildew.
Yeah.
We wanted to make it the nicest building or the nicest unit that we had, just to see how far we could push the rent. And
Yeah.
then when we did it, we put it on market and it went like that at $100 premium to what we thought we could get for it.
Yeah.
And so that part of that was we were okay with waiting, for it to come down because it's only one unit. It's like we're trying to turn every unit, but because we know
Yeah.
one unit can do it, now we're like, how many can it support, right? How many of these other units can we turn to achieve that much higher rent than we originally thought? And so
Right.
part of it is, like you said, you kind of just advertise higher, see if there's any bites. And based on the amount of bites that we got, we realized, oh, we can keep going with this, right?
Mhm.
So that's how you kind of test the market. And you should always be testing the market, right? Otherwise, you're missing out on this term loss to lease. You're missing out on more rent that you could be achieving, especially if you are getting other tenants that are being priced out of neighborhoods that are deciding your neighborhood might be cheaper and better. So the unit looks nicer, right? And they're okay with the tenant base, but originally they lived in, say, a Class A area, but they lost their job. And so now they are trying to downgrade to something that's perhaps cheaper, but still of a nicer quality. And that hopefully answers Travis's question, which is, was there any way to have known those Class B tenants were around the property? Looking back on it, seems like a pleasant surprise. The answer is, yeah, kind of. We were pretty close to San Marco. We're called the park at San Marco, but we're a bit further inland. There's a Class A neighborhood on the water that you can technically drive to within. How far is the drive to the water from our building?
25 minutes?
I'm gonna
I think it's 25 minutes.
25 minutes.
No, it's actually
No.
closer.
I'm not talking about the ocean water. I'm talking about just the
Ah.
river.
The river, 15 minutes.
Yeah. I'm
Not
gonna
far.
see. Yeah. If you want to let me share screen, or if you want to do it,
Sure.
if you want to pull it up on Google Maps real quick for him.
Oh, here. You got it, or you want me to do it?
Oh, yeah, I could do it. So this is our building. It's got terrible Google reviews, as you can tell. We're hoping to fix that. So here's the Sterling at San Marco. And then this area, like along the water, is Class A, right?
Yeah.
So it's like you can see the lofts at San Marco. There's a dispensary there. It's kind of a high-end area.
Yeah.
And then, further in, you get more B class. And then we in this area are definitely more C class. You can kind of tell when you zoom in. There's a thrift store, there's coin laundry, hot walk, Family Dollar, auto parts, right? So this place, or this neighborhood, is definitely like C class material.
Mhm.
But the closer you get to the water, and somewhere in between, there's a B. And you can tell it's incredibly close. This is probably within 2 or 3 miles of the actual river where the Class A stuff is. So
Yeah. And another way you can tell, I'm a realtor, so I always leverage this part. You can use Zillow is a little off, but I like to use Redfin.com, or you can use realtor.com and just search for the single family residential home sold price nearby, right? And then just calculate out if you're surrounded homes that are $300,000, what kind of income do you need to make to buy that kind of house, right? So then you can figure out, well, how far is the property you're looking for from those $300,000, $400,000 home? If it's very, very far, then you're not going to attract quote unquote B class tenants. If they're nearby, as the price rises, they might stop by and look at your property. And then at the end of the day, it's just your leasing staff be able to sell to say, hey, we got great things, and so on and so forth. Yeah.
Yeah. So this is a website called citydata.com. It's a way to track incomes. So for example, this area, like for y'all it might seem low. Jacksonville, 63,000 is considered A class. If you're Californian, you're like, what are you talking about? That's minimum wage in California. But so you can actually check incomes by census tract on city data, right? So our neighborhood here is 30,000. So we're half of what class A incomes are, right? 63,000 here. And so the closer you get to the area, obviously the income starts trickling down. It goes to 40 here. And then our neighborhood is 30, right? So we were already kind of close on this side. And then on this other side, you didn't see it, but there's actually a couple hospitals. So we're actually sandwiched. Like this area, you can tell is kind of lower income, but we're sandwiched between two places that are extremely wealthy. This place income is low because it's right on a rail line. So I don't think anyone actually lives here. So I don't know how they picked up income for that. But yeah, and then here's the ultra wealthy, right? Like I said, the closer to the water you get, the higher the income becomes.
Yep.
This might be 60,000 because you get a lot of young working professionals. And then this is like retirees with, 6-figure median incomes or whatnot. So, but City Data is a website I use a lot. Highly recommend you check it out as well.
Yep. And you got to know your sub-market, right? It's no secret that Florida is a retiree neighborhood. So depending on which neighborhood you're looking at, their income might be zero because they're retiring. But if they can afford $300,000 homes or even home on the river, no income means they still can afford. So I wouldn't worry too much about that. Look for high-end high-end retail, anywhere that Starbucks and Chick-fil-A goes to. I'm sure they're not putting in a cheap neighborhood. So those are a couple signs that as you get used to it, it's very repetitive between different cities. And you just need to kind of understand that personality in that city to know what's the hot pockets and what's not. All right.
Yep.
And
all right. Go ahead, Chris.
Yeah. So we kind of talked about, what we're projecting: 2-bedroom, 1,100, 3-bedroom, 1,300, and then we're just kicking butts thanks to the management company, and then the market carrying us for the ride. Okay. So to sum it all up, right? If you're out syndicating, or if you're trying to partner with another syndicator to invest your money with them, these are the takeaways I hope you remember. One, follow where the money goes. Your life is so much easier when the market is kind of help going there, right? Austin is a no-brainer, right? Everybody knows Californians are coming and they keep coming, right? So yes, it's crazily expensive, but time and time again, I hear California investors saying, oh, so cheap. I get such a big house and big yard for half the price I pay in California. And that's why they keep coming. Okay. And just look up these data, which city is trending, which one's hot, which one's not. So that makes your job so much easier. Okay. And now don't party hardy. Every party in the world has to come to a stop. So what goes up must come down. So make sure you prepare yourself for what could change, but don't be so scaredish that, hey, what happened tomorrow? Everything goes to zero. It's not. Okay. Just think what would happen from a major macroeconomic perspective. Jacksonville, Florida is doing 20%. Austin's doing, I think, 16% rent increase. Okay. Everybody will have to shrink tremendously before you have a lot of cities that go to zero. So Dallas, I think their rental increase is 8%, maybe. So by the time Dallas dropped to zero, 20% minus 8, well, I'm still good for 4%. Okay. And then last thing, go with somebody have done it before. Okay. You don't want to be the first guy trying out a new syndicator in a brand new market that they haven't been successful at. Okay. I've seen a lot of syndicators who are good in Texas, who are good in Phoenix, but fail miserably in other neighborhoods. Okay. So make sure they have a track record in that particular submarket before you give all your hard-earned money to them. Okay. With that, I'll turn it open for questions.
Nice. Great sale, Chris. It's a great pitch.
It's not a sale. I'm just trying to help people out.
Yeah, thanks again. All right, that being said, we're kind of done for the question for the presentation portion. Is there any particular questions people want to ask? Chris, do you want to sort of dive in and show what we do like in a meeting even? Like, for example, what we have for keynote and who we have on staff? That might help a bit as well in showing
Are you
what,
talking about an operation perspective?
just operation side, yeah.
Sure.
I have a quick question. In terms of minimums per LP, what do your minimums look like?
Minimum investment for our deals. We don't have one for right now, but generally we do 50 to 75,000 per investment.
Got it.
It
Okay,
depends on
thanks.
how big the project is. So
Yeah.
Got it. Thanks.
Oh, that's the wrong one. Hold on. Wow, it's been quiet, so I guess I confused a lot of people.
let's just show off.
Yeah, go ahead.
Have any of your deals gone full cycle yet?
Mine have,
Chris?
the San Antonio one, we exited in 3 years.
It had a very fun surprise, right? But
Oh,
the
my
insurance
God.
payout was good. Okay. Thank you.
Yeah, that particular San Antonio one, it's definitely not a home run. That's kind of go into what I mentioned earlier, right? You want to be in a market that runs up. If you remember the slide, San Antonio is one of the top 10 fast increasing rent cities. Historically, it was not. So we were hurt quite a lot by COVID. People just stopped paying rent, right? So I had people that didn't pay $17,000. So basically 13 months, 13 to 15 months rent unpaid, and just say, hey, and then we try to give them all the help they can get, helping them to, find all the rental assistance program and everything else. Literally, the staff have gone as far as, we fill up all the possible blank spaces for you. You just need to sign, and they refuse to sign. And they just say, hey, you know what? That's rent is your problem. And then eventually we have to evict them out. So take a $12,000 hit for somebody just free riding. And then that's not just the one case, there's a lot. So yeah.
Still had a decent return, teens IRR, but right. So
Yeah.
The big issue was just like the initial COVID shock, because y'all purchased before COVID happened, right?
Yep.
And then that kind of hurt you guys later on. But yeah. And then also property management wasn't as good as the one in Florida, right? If I remember correctly.
Yeah. Oh yeah. Keep the question coming.
What percentage do you typically finance on each one of your deals, or is it all cash?
Normally 75 to 80% financed. So a typical deal is 80% on the purchase price, and then about 90 to 100% on the rehab.
Got it. Thanks. And then upon an exit, does each LP also get their share of any potential equity that's available, or appreciation as well, right?
Yeah. So now the more and more syndicator prefer to do a pref. So that means you get your initial equity back plus the 8%. So LP gets paid first. And then after that, then there's the 20-80 split or 70-30 split.
Great, thanks.
Mm-hmm. All right, another Tao. Hey, Lipe. Do you guys have experience in Jacksonville before you're both in Texas? Mostly relying on property manager XQ. So the answer is Nielsen and I don't have experience in Jacksonville. However, for this particular property, It's a joint venture. So three of the business partner have experience in Florida. Two of those guys, two of the three have 3 property gone full cycle in Jacksonville. And they're the one that brought in the kick-ass property management company. So although Nelson and I don't have experience, the partnership have, and that's why we are able to collectively knock this thing out of the park.
Yeah, one of the benefits is like between all the partners, we are 40% or so of the property managers, like 1,000 units that they're managing, which is it 30 or 40? I don't know the exact number, but once you have a large enough margin, you have a lot of negotiation leverage with your property manager, basically.
Yep.
Okay. What
How does
was
that
the
compare-
projected?
Yeah, about the rehab, I can jump into it now. This is a little bit old, right? This is April 20th of this year. So to answer that question, I can go through quick high level. This is what we do every week between the ownership and the management company. Okay. We get together, talk about how well the property is performing. And this is the slide deck in the meeting notes get produced afterwards. Okay. Typical run of the mill, we always talk about money and expenses, okay? Are you achieving your goal? Are you overspending? So on and so forth, okay? And then we go into occupancy, who's leaving, who's renewing, so on and so forth. How much people are owing us money, whether we want to evict them or not, okay? Then we go into-
If you're curious, terminology for that is KPIs. We measure our achievable indicators to tell us how the business is going. And then we go into part 2, which is, go ahead, Chris.
Yeah, no problem. So then we watch where the money is spent, how we're doing in the CapEx. So overall, back in April, we're 71% spent. Okay, and then we will be, I think this one's a little bit older version. We're under market, but we're under budget and have about, I think, $34,000 left over if we execute all the projects so far.
Yeah.
So the answer is yes, we're under budget, and this is how we track it.
Yeah. We have a project manager who handles a lot of these updates and the weekly, numbers. So.
What has been the most challenging part from a GP perspective, and how do you guys go about those challenges?
Finding deals.
Yeah.
Thank you.
Operational wise, we have it pretty good. There is some expense increase due to supply chain. One of the challenge is that our unit turns are slower. So we have, let me see, maybe it's in here. Yeah, unit here. So these 4 units, they end up leaving because we increased the rent. And the turn took longer. We were expecting 2 weeks, but it turned out to be, I think, ongoing 2 months now. So that was unforeseen, and of course it hurts the overall income.
Yeah. Okay.
What else?
How frequently do LPs receive investment updates, and what are some of the frameworks surrounding potential capital calls? LPs will usually receive updates in a quarterly memo. Really depends. If you wanted to know more, I'm on Facebook all the time and I talk about what we're doing. So technically you get sooner updates on my projects, but I don't know how often Chris likes to do it. I've had partners in the past as well. there's people I work with in Chicago, they like prefer to be very secretive. For example, we're in a neighborhood where we don't necessarily look like a lot of the tenants. And so I understand where they're coming from, where they don't necessarily want everyone to know what we're doing. Whereas Chris so far has been a lot more open. He's okay with us kind of shouting from the rooftops, you know, our numbers, what we're doing, et cetera, et cetera. So it depends on the syndicator who's managing your project and how often they want to update.
Yeah, I typically like to update my investor on a monthly basis.
Yeah. But yeah, what are some of the frameworks surrounding potential capital calls? Chris, any ideas on this one?
All right, so capital call, it's a root canal. Nobody wants to talk about that. A good syndicator will typically take the hit first. Okay, again, deal by deal. Okay, I'm speaking from my San Antonio property. Okay, GP took a huge hit on bringing in capital, more than $1 million. Yeah, more than $1 million, and we never touched LP's money at all. Okay, so it depends on the deal. We generally like to run it. The GP gets the hit first, and then absolutely unsustainable, like meaning we ran out of money. Then we go into LP and say, hey, look, you know, power of the masses is much stronger than 5 people. So, you know, at the end of the day, everybody still make profit from my San Antonio property. So that's how we do it.
But again, to clarify, every investment has risk. Nothing is perfectly safe. Right. This was a COVID issue, right? So
yeah,
if you predicted COVID, good for you. But you know, a lot of GPs went through the same issues where they took their own money, put in the project to keep it afloat, mainly because you weren't allowed to evict at all, right? So it's not like you control a lot of those things. And so I had some of those issues too in Chicago. But for us, the cash flow is a little easier because no one is buying in Chicago. So, you know, we can get a bit higher, but we ran into operational issues as well. But I think everyone encounters those, especially during the COVID era when evictions weren't allowed. So,
yeah.
But moving forward, since that's kind of out of the way and there's still liquidity in the market, I don't think there's going to be as many of those as moving forward for everyone.
Yeah, eviction is definitely lifted, right? And so going in and out these days are just, you don't even feel like COVID anymore, in Austin at least. So yeah, it's going to be a thing of the past and people are going to forget, and then massive eviction is going to happen, right? It's already happened in my property in San Antonio. So people are cleaning the bad tenants out, and if you don't pay, you gotta shape up.
But okay, so that's kind of it. I've also been getting questions about the likelihood that the market's going to crash. I had some data on the Notion. I don't know if everyone's ever heard of the Notion, but we keep track of it here. I'm going to go over it real briefly in case you guys are still curious about what happens in a market downturn. I made a post about this today, but the question is, will real estate prices collapse again? My argument is probably not. It's going to correct, probably somewhere 5 to 10%, but I don't see it wholesale falling. Now, part of the reason is because real estate prices have never actually collapsed or fallen except for that one time in a recession. And that was because that recession was actually caused by the housing crisis. But now we have this trauma associated with 0809 that we think it's going to happen every single time. But the recessions in the 1980s, the recessions in the 1990s, even the 2001 recession caused by 9/11, real estate prices kind of stayed either flat or went up slightly or dipped slightly, right? So the data has shown us historically, there's a reason why people used to say real estate only goes up, because up to a certain point it had, until it was caused by the subprime mortgage market. So subprime loans, I don't know if you guys remember, are these loans that you gave out to anyone who wanted it, and it was like 23% interest rate, and you what they did was they would treat this loan as a grade A asset because real estate had never collapsed, and they would just sell this on the stock exchange once they packaged a bunch of them. Now, after the Great Recession, they passed this thing called the Dodd-Frank Act that says, y'all can't do that anymore. So they actually check income now. That's why to sign 100 pages of stuff now. You know, they've really capped the amount of loans you can get by lying about your income. And so even in like these no doc loans, like DSCR loans, for example, they might not check your income, but they check how much rent that the property generates, right? So if you don't have income, they want you to put enough down payment where the rental income could offset your personal income that you generate from it. So on top of that, once you had the subprime loans, you had a lot of overbuilding. However, once it dipped, we have never actually recovered. So this was the 08-09 crash, and this is where we're at today. We actually still aren't building as many homes as during the 08-09 crash. This actually pairs up with the amount of homes we were building in 2001, right? So if interest rates shoot up right now, it's not going to crash the market because I don't think there's enough supply to do that. However, you know, if we let interest rates stay low and kept building for a long time, it'll definitely get to that point. The thing is, we had 6 years of runway between 2001 when the interest rates were lowered, and that's actually what caused the real estate kickoff the first time. And 2007, when it actually crashed, that was a 6-year period where you're just building a bunch of homes. We've only had 2 years of super low interest rate environments, right? And then not to mention the 10 years, you know, prior to that, where there's a deficit following, you know, the 08-09 crash. And so my argument is that the subprime loans caused the market to crash, but also caused it to pick up in the first place. We don't have that same issue today. And so at the moment, I don't really think it, you know, this is also opinion. This is not real estate investment advice. Don't listen to me. This is just my opinion. The 08-09 recession was caused by too much supply and basically bad loans. So, but what about the fact that home prices shot up a bunch recently, right? Well, does that mean they have to come down by a lot? Not necessarily. So it helps to understand why the prices are up and why sometimes they go down. Why would you sell a house? It's because you can't afford it, right? So who are the people who can't afford, you know, their mortgages? Well, there's two ways to pay for it. There's either your income, like your personal generated income, and back in 08-09, you could actually lie about this. This is what led to subprime loans getting defaulted on. Or you can support it through rent. And rent doesn't, you know, if the rent doesn't support the mortgage, then you're kind of screwed. However, cash flow is king and rent has never universally fallen. So I put a graph here. I don't know if anyone can see it, try to expand it. But basically on the consumer price index, real estate as a whole has collapsed in values, but the rent has always stayed, you know, somewhat stable. Like even the 08-09 recession, if you look here at this gray bar, the rent went sideways and went back up. So why is that the case? It's because rent's a commodity. It's like food, it's like water, right? Everyone needs it. When you got foreclosed on in 08-09, you still needed the place to live. And so rent actually went up in some neighborhoods, mostly C-class, B-class neighborhoods, once people started trying to downgrade from the A-class buildings. And so those are things that typically you would want to take into account when you're investing, right? Does your area look like people can support incomes? I live in Austin right now. I think Austin prices don't really support itself right now through rent, but I know a new Apple employee, and they're hiring 20,000 of them, starts off making about $150,000 a year. $150,000 a year can buy a market price home today and have a little bit over. You can borrow more than that. And so from what I can see in Cupertino, like where Apple's home campus of 40,000 people is, homes start at 2.5 million. In Austin, in that same neighborhood, homes start at 500,000 and they're hiring 20,000 people. So half of the Cupertino campus is being moved to Austin. That tells me that people can typically support, you know, the prices, even though they've gone from 300,000 to 500,000. 500,000 is still nothing if you're thinking about the amount of income that those employees can generate. Travis can back me up on this. We were talking about Apple incomes recently. But if you can't support it with income, can you support it with rent? And that's what's happened in Jacksonville. Jacksonville prices are also up around 20%, but so is rent. So what that means is, can you still support the property through rent? And as long as you can, back in 08, 09, they forgot about this. Well, then you can probably support the building, right? The American South and Southeast, I think, are going to keep maintaining. And then a lot of those six-figure incomes are now leaving San Francisco and New York. It probably won't collapse those cities either, but it just means they're not going to grow as much as they could have without those six-figure incomes competing for space, land, homes. And so the reason real estate is so resistant, it takes a long time for the market to crash. The dips are usually kind of slow. You can't just sell all your stocks overnight and have the market drop 20%.
Yep.
So if there is a downturn, it's got to last at least a year before we see any significant dips that people start, wholesale trying to sell off a bunch of homes. But even right now, we're at an all-time low in terms of supply. So that wholesaling, off homes only happens in a scenario where, one, people lose their incomes. So for example, if you are working at Apple and Apple lays off, 20% of its employees, that could mess up Austin, right? The other option is all the short-term rentals in your town. When the recession hits, short-term rentals tend to not make as much income. The hospitality industry usually gets hurt pretty hard, once there's a downturn. So if you have a short-term rental downturn and you can't make the income, what do? You try to sell the building. And so it might not affect you if you're in Austin, where it's a 2.5% of listings to home ratio in Austin, but in Orlando, it's 10%. So if you're a vacation market and everyone decides to sell homes at the same time, and that's like 10% of your market, you could be in for a lot of risk and pain if there's a glut of supply like that. That being said, that's actually why we like Jacksonville and Tampa. They're actually not as vacation heavy and more finance oriented, whereas cities like Orlando and Miami have had a lot more vacationers and short-term rentals around town. And so you have to be careful in that scenario where if there's a downturn, a lot of single families decide to offload and turn into either rentals or go for sale. You're gonna have a lot of competition and supply glut from there as well. And so that being said, overall, the market's still strong. People have money to spend. I don't really see a massive recession. I see a small correction. It'll probably peak in about a month or two in June, July, and then it's going to dip to the bottom around December. And then in 2023, probably late 2023, it's going to pop off again, just because people are going to realize the downturn is not as bad as it was. The Fed has stopped increasing interest rates. And then 2024 is going to be a massive real estate year. So if anybody wants to correct me on that, please remember me and tag me in a year and be like, you're totally wrong, Nelson. The whole market tanked and you're done for it. And so, I'll be glad to eat that. But right now, based on what I'm seeing, the income and the rents are supporting the valuations. And that's caused by inflation, not by a crazy real estate valuation market. So someone started crystal ball post. Yeah. Someone rag on me and like call me out in 2 years. I want to be called out to see how close I get. The last time I did a prediction, it was a COVID prediction, and it was that markets would dip about 5-10% before coming back up, and then they did. But also it was COVID, so like everyone could kind of see where it was going to go in the future, right? Okay, so that's another prediction holding me to. That's kind of it. Anyone else got questions for the night? Otherwise, we're going to call it because it's been a full hour at this point. Okay, in that case, everyone have a good rest of your night. One last question. How do you find your sales comps, and are you adjusting your hold times reversion cap rate given the current environment? Sales comps are pretty easy to find. Usually you ask a broker, they're not very easy to find online, but you have to usually talk to a commercial broker, and we do that pretty often. And so that's how we find sales comps. And then are you adjusting your whole time reversion cap rates given the current environment? Yes, we're increasing cap rates by 0.5% compared to market. And then what are your cash flow distributions? Typically try to target 7-8% annually. It depends on the project really and how much work has to be done. Sometimes there's going to be a year where you're just doing a rehab before you can start paying cash flow because there's so much work has to be done on it. But yeah, that's all the questions. Thank you all. Have a good rest of your night.